Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include mergers, acquisitions, and shutdowns. Oh my interview with CHLA's Taylor Stork on why FICO's direct licensing pricing creates more options for consumers and lenders. And yes, if we start to see mass layoffs, it will certainly slow the economy. Looking for an all-in-one automated VOIEA platform that helps mortgage providers achieve up to 50% cost savings and industry-leading 75% completion rate? Look no further than TrueWork. You can learn more at truework.com. Often, the economy and general business trends are separate from management and business acumen, like Blockbuster, which at the high point had over 9,000 stores. Rite Aid had 5,000, now it has 0. Companies have to react to changing times. Remember when CVS began locking its shelves to stop theft, and then made users add its app to help unlock them? Independent mortgage banks are taking note that Fifth Third announced it will acquire Comerica in a $10.9 billion stock deal. It would create the nation's 9th largest bank and could be the start of a long-anticipated consolidation among the bigger regional banks, since there is an expectation that the Trump administration will look favorably on such deals. Yes, the government's still shut down, and maybe we should talk about it a little bit, as the USDA has furloughed most of its staff, halting loan guarantees and conditional commitments. FHA has a contingency plan and is keeping endorsements moving, but has suspended HRAP condominium approvals. VA lending and Ginnie Mae operations continued, though with thinner staffing, and Fannie Mae and Freddie Mac remain unaffected. FEMA, meanwhile, cannot issue new or renewal flood insurance policies, leaving borrowers to seek private alternatives. Economic data being delayed due to the government shutdown is leaving markets navigating uncertainty using alternative indicators. Last week, the JOLTS jobs report revealed layoffs are occurring at their fastest pace since 2009, highlighting a cooling labor market. The ADP employment report showed private sector losses, while the ISM Services Index indicated contraction in business activity for the first time since 2020. Despite these signals, consumer spending has remained resilient, though it is partially driven by one-off factors such as the spike in auto sales of expiring EV tax credits. This resilience is fragile, as prices remain elevated due to tariffs, and signs of labor market weakness suggest the broader economy is teetering between stagnation and slow growth, leaving the Fed and markets in a cautious, data-starved holding pattern. Beyond the economic uncertainty lies a deeper political risk: the potential for the Trump administration to exploit the shutdown to enact permanent restrictions in the federal workforce. Statements and past policy moves suggest a strategic opportunity is being considered under the guise of fiscal prudence. While the feasibility of such a restructuring remains unclear, the mere possibility is beginning to influence market sentiment, adding political volatility to already shaky economic foundations. This potential shift could reinforce investor wariness in an economy where asset-holding consumers spend freely while lower-income households bear the brunt of growing economic strain. For today's interview, I wanted to welcome back to the show CHLA's Taylor Stork to talk about why FICO's direct licensing pricing that was announced last week creates more options for consumers and lenders. However, the mortgage industry should remain wary of FICO's monopolistic pricing and practices.
FICO for so long drew the ire of people in the industry. And for those that might not know, FICO has announced this direct licensing program, which is meant to create more options for consumers and lenders. They're kind of cutting out some of these credit reporting agencies. Is FICO now doing good by the industry, or can we say that categorically?
Yeah, I don't know that I can answer that question because it's not really their responsibility to do good by the industry. FICO is a publicly traded, publicly owned company with shareholders, and their fiduciary responsibility is to all the people that own their stock. They're not a nonprofit that's out here just to do good. I think that the introduction of the score in 1986 did a lot of good and created a lot of value for the industry. But I don't know that I would characterize it as good or bad necessarily. I just would characterize it as they're making a change to how they distribute their product.
Do you believe the change will benefit the end consumer or the mortgage industry? Do you that It's kind of the intent of the question, but I know you love semantics.
I do love
I know
semantics.
you do.
I do. Okay, so let's unpack that question. Will this be good for the consumer? And then will this be good for the mortgage industry? It's really two different questions.
Mhm.
And sometimes when the stars align, we get the same answer for both, right? But the stars don't align very often. I think that my personal opinion is that in the long run, changing the distribution model of the FICO score is good for the industry and for the consumer. So let's talk about what that actually means. Everybody right this minute is focusing on a pricing announcement. And the bigger picture is actually not the pricing. The bigger picture is the distribution. So for well over 30 years, FICO has distributed their score through the bureaus. And the bureaus resold the score as part of their product to the CRAs. And then the CRAs resold the completed credit report with both the score and the data on it to either the lenders or the consumers, right? Depending on whether or not the loan closes. The change, which I think is a fairly substantial change, is not about the pricing. It's about the fact that now it's CRAs who are going to be distributing the score, not the three bureaus. And there's a lot to unpack around that because you're upending 30 plus years of business tradition. And we don't know how all that plays out yet. This is brand new.
CHLA, of which you are affiliated, has called for, and let me get this correct, the vibe. So CHLA has called for Fannie and Freddie setting up their own credit scoring subsidiaries, which can be spun into marketplaces. Why is CHLA advocating for that?
Okay, so that's a great question. One of the foundational tenets of CHLA is that there should be competition in the marketplace. And specific to credit scores, credit scoring, and credit reports, we believe there should be competition in the marketplace. We believe that competition breeds innovation, and that competition also drives prices down, not up, as a general philosophical economical rule. So when you look at the credit scoring models now, theoretically, there are now two models. When you look at credit scoring, Fannie Mae and Freddie Mac both have an absolute requirement that you have to have a FICO score, right? You have to have a credit report, got to have a FICO score. And the minimum viable FICO score that is eligible to be purchased by the entities is a 620 FICO score. Some of that has to do with the actual capital requirements for the two entities themselves. Some of that has to do with their appetite for risk. But fundamentally, once you have that 620 score, when you look at the way that DU and LPA both operate, they do not evaluate a credit score to determine whether or not a borrower is approvable through the automated underwriting systems. They look at the credit itself, but not the scoring. So they're looking at the data, but not the result of a complex algorithm. We believe and have long held that if Fannie and Freddie have the capability of evaluating credit based on the data, they also have the ability to evaluate whether or not a loan should be eligible for purchase based on the data itself.
I'm wondering how wary people should be. A little smoke and mirrors here of, hey, this seems like it's a good step toward addressing FICO's monopolistic pricing. However, they could have FICO or Fair Isaac could eventually squeeze out Vantage Score and the credit bureau model altogether, which is kind of back to a monopoly. Is that something to keep an eye out for?
It is absolutely something to keep an eye on. And the fact that a second credit score, the Vantage Score, is in fact owned by those same three bureaus that were previously selling the FICO score is another topic to pay attention to as well. Because remember, the way that the actual pricing was distributed was that FICO sold the score to the bureaus for $4.95 per score per borrower. And then the bureaus resold that score to the credit reporting agencies, often marking that score up at least another 100%, which is why we would see much greater price increases when we looked at our credit reporting invoices than what had been kind of publicly announced. because these scores were getting marked up and marked up. Ultimately, the bureaus had control over what the end pricing was on the score after FICO set their baseline score. So the concern would have been if the bureaus now price the FICO score and also price the Vantage score, which they own, which theoretically competes with FICO, how do those pricing dynamics play out, right? So by changing the distribution model, what FICO has effectively done, regardless of whether we are looking at pricing from the perspective of a consumer or pricing from the perspective of a lender, what FICO has effectively done is removed the pricing of it entirely from the bureaus and put it in the hands of the credit reporting agencies. And the credit reporting agencies are the folks that we actually buy these reports from.
I'm going to be cynical here for a minute. Because
I can't imagine you being cynical.
Yeah, good. There's all this talk about credit costs. Credit costs. This will help. Oh, they're so expensive. I don't think credit costs change affordability that much. We talk LO comp, we could talk insurance premiums, we could talk property taxes. There's a variety of things that seem to be much bigger issues in the home affordability debate than this. Why has it gotten to the point where people care so much about credit costs? Like that's the thing in the room, the evil in the room that we need to get rid of.
Yeah, that's actually a really good question. It started in 2022. It started when FICO first made an announcement about price changes, and they announced very, very quietly amongst a small group of lenders that certain lenders would receive preferential pricing models over others. And I think that fueled a frustration in the industry in general, which started a lot of this conversation. Now, that pricing model has since been adjusted and rescinded and removed. But I think that's what began to answer your question, I think that's what started the ire of the industry. And then I think it continued as the industry realized that it had zero ability to negotiate these price increases, right? So in a traditional business model, you go to your vendor, and if you don't like the price they're telling you that they're going to sell you their product for, you go, well, look, I don't like you. I don't like your price. I think you're great, but I don't like the price. I'm going to go to your competitor and get a better price from them. But when you have a monopoly structure that is driven by guidelines that will only allow a FICO score, it exacerbates the situation because you can't go negotiate with somebody else. You're not going to go call TransUnion and say, hey, sell me the FICO score for a lower price than the Equifax guys are selling it to me for. That they would laugh at you. There's no conversation to be had. And so I think the frustration, whether it's over 5 cents or $5 or $500, I think part of the frustration is the lack of ability of the lenders to actually have those conversations and control their costs through vendor management. That would be the first piece. The second piece I would say is the piling on year over year over year of substantial price increases, 100%, 200%, 300%. There rarely do you see price increases of those percentages outside of like the pharmaceutical industry. If you told me that my car that I bought this year for $80,000 next year was going to be $160,000, that wouldn't happen, right? And if you told me that the gasoline, because suddenly there's a gas shortage, if you told me that my gasoline that I usually pay $4 a gallon for is now $8 or $9 or $10, then the local governors would be talking about price gouging activities and Sherman Act concerns and pricing abuse. And yet somehow during the period of 2022 to 2024 and into 2025, it was acceptable to double prices every single year. And, I think that was a source of frustration for people.
I'm glad we had you on to make heads from tails of this. What should people pay attention to going forward? What are you paying attention to? What's CHLA paying attention to as this plays itself out in practice?
That is actually the $1 million question. That's a great question. So I think it will be very interesting to see how the three bureaus respond in their pricing structures and what the actual credit reports cost, right? So we have in the credit reporting space, we have this weird model. You have three bureaus that completely control the data and operate very, very closely together, and all of them are required. You have a one score, which controls the algorithm, and soon Vantage Score will become a viable second option, but it's not quite there yet. And it's not there for a lot of different reasons. The bureaus, sorry, not the bureaus, the agencies are racing to get things implemented. Technology needs to be updated. All the pricing engines and all the LOSs and POSs have to be reprogrammed. There's just a lot of plumbing work that has to be done before Vantage Score is going to be able to be widely adopted. So you've got this weird distribution model, and then the four of them sell the product through roughly 40 credit reporting agencies. There's actually about 80 in total, but a lot of them are joint ventures. So there's really probably 40 unique credit reporting agencies. And amongst those, there's a handful that do the lion's share of the work in the mortgage space. And what I would remind you is that there's a lot of confusion right now. In fact, I've heard people say, yeah, we heard that, credit report costs are going down. I do not anticipate that credit report costs are going down. I would not be surprised if the actual total price of credit reports is higher on January 2nd than it is right now. A lot of that is going to be dictated on what happens with the three bureaus and what they do with their pricing models, because ultimately the bureaus are going to provide their pricing. FICO is going to provide its pricing. It's going to go to the resellers, and the resellers have to figure out how to package it all together and give us a credit report. We won't know what this looks like for at least a few more weeks. In the meantime, I think it's important that we all just pay attention.
Mm-hmm. Final question. Do you think this helps innovation, hurts innovation? Because you could argue that the way credit is assessed is ripe for that in this industry. There's neat ways that it can be done. Helping or hurting innovation?
Helping innovation.
Good.
Yeah, I believe that this starts to open the doorways for more competition in the scoring space. And there should be more competition. There should be a third score and a fourth score, and we should figure out which ones we like most and be able to use the ones that meet our business models and still ensure that a loan is eligible for sale to the agencies.
Very well put. Always a pleasure. Appreciate you making the time, and we'll talk to you soon.
Thanks, Robbie.
Even if the government reopens, this week's calendar will still be light on data, with employment trends, trade, consumer credit, wholesale inventories, Michigan sentiment, and the budget statement. Should the shutdown continue, you can expect the trade deficit, wholesale inventories, and weekly jobless claims to be delayed. The list of Fed speakers is on the heavy side starting tomorrow, and the minutes from the September 16th and 17th Federal Open Market Committee meeting will be released Wednesday afternoon. Treasury will conduct the mini refunding consisting of $58 billion of 3-year notes and reopen 10-year notes and 30-year bonds for $39 billion and $22 billion respectively over Tuesday to Thursday. For MBS, the agencies will release prepayments today, beginning in the late afternoon and into the evening, with Class A 48 hours on Thursday and Class B out on Friday ahead of the long weekend. Today's data sees just employment trends for September due out mid-morning. With the lack of government economic announcements, we begin the week with agency MBS prices a few ticks worse than Friday's close. The 2-year yielding 3.59 and the 10-year yielding 4.15 after closing Friday at 4.12%. Let's wrap up with a joke and some housekeeping. I have a buddy that likes to say, I always look for a woman who has a tattoo. I see a woman with a tattoo and I'm thinking, okay, here's a gal who's willing to make a decision she'll regret in the future. Thanks again to TrueWork for sponsoring today's podcast. TrueWork is the only all-in-one automated VOIEA platform that helps mortgage providers achieve up to 50% cost savings with an industry-leading 75% completion rate. To learn more, visit truework.com.